It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being here, friends. My name is Mike Bernard. I am your host. I'm also one of the certified financial planners on the program. And with me in the KFG studios, my business partners and fellow CFPs, Kevin Korhorn and Josh Gregory.
Today on the Wise Money Show, we're teaching you all about IRMAA. That's an acronym, and it stands for Income Related Monthly Adjustment Amount. Kind of a mouthful there, but it's a surcharge on your Medicare premiums that tend to hit high savers the most. How does it work? And more importantly, how can you plan ahead to reduce the chance that you'll be hit by it? That and more on this episode.
I'm proud of you, Josh. I mean, you were able to say that with not only a straight face, but almost with a smile and like happiness in your voice. Every time I talk about IRMAA, it sounds like I'm complaining.
You're growling.
I am. I'm mad about it. We're going to help you avoid it and maybe be less mad because it won't impact you. We're going to get into all of that. If you have a question for the program, we'd love to hear from you. You can call or text us 574-222-2000. That's 574-222-2000 online. You can find us wisemoneyshow.com. Reach out to us there. And then all over social media, wherever you're at, we are there as well. Search the Wise Money Show. And we're going to talk about how you can plan to avoid IRMAA. And if you're unsure, if you've got a plan that is going to put you on pace to avoid IRMAA, reach out. We are here to help. Because a $1 mistake, $1 over the limit, can cost you $2,000. And that's just one example, okay? Yeah. And get this. Oh, it's almost like you can't make this up. $1 over a limit. Okay, then what's the limit? You don't know.
That's right.
I mean, we'll tell you
won't for a while.
You won't for a while. That's one of the paradoxes and one of like the just frustrating things about IRMAA. And so, yeah, we're just on the other side of this tax season, 2025. Hopefully you've forgotten all about it, but you might want to pay careful attention to what your adjusted gross income was on your 2025 tax return because it's going to come back potentially and play a big role for you.
Can I confess to you that as a financial advisor for my entire career, IRMAA is the thing that makes me the most nervous. Like I'm going to, trigger a strategy that accidentally increases someone's income just a little too far.
Yeah.
And they'll pay the cost for that for an entire year at some point.
No, I agree with that because I fear that, we know what the IRMAA bands are today. We'll share it in just a minute. But, for next year, they're going to walk them back 10%. They're going to reduce them significantly. And where we made some, planning decisions that assume that those stayed intact. So I share that same.
I'm sure that's an irrational fear because they generally increase them every year. But those are the types of things that make you second guess, or you want to be conservative in your planning. And I don't know.
So one thing that IRMAA does help kind of really illustrate, it's one of the irrefutable examples how all 6 areas of your financial life are actually interconnected. Mm-hmm. Because IRMAA, this is a surcharge on your Medicare Part B. That obviously has to deal with your retirement plan, right? How much is healthcare going to cost, your Medicare going to cost? You got to build that into your retirement plan. But it's cash flow. Mm-hmm. So it's your present financial position. We're talking about insurance, so protection planning. It's a surcharge based on your taxes, your taxable income from 2 years ago, so tax planning. And then estate planning is the only one that there isn't this direct correlation. But this one issue touches clearly 5 out of the 6 areas of your financial life. And so you've got to have an integrated approach to your financial plan. That's why every time on the show, we talk about the 6 areas of your financial life.
Well, here's how it could touch your estate planning too. Often, let's say you inherit. You're the inheritor, not the one leaving money behind, but you receive an IRA from a family member and you have to start drawing off of that account. What if that's what pushes your income just a little bit higher and all of a sudden you're into the effects of IRMAA?
Great point.
Yeah, I mean, we look at the prior year, so there are exceptions. So you can, if you retire, you can get an exception to this. The folks that are affected by IRMAA are the folks that keep working or sell their business, and they have this income that they can't do anything about. Mm-hmm. And that is up until you get to required minimum distribution. That because when we started, you said this impacts high savers. I'd say it really impacts high earners. Now you would say high savers are downstream of high earners, but really it's the person. I mean, when we look at IRMAA and what someone could pay for health insurance, I mean, you're talking about it's $1,000 a month per person for Medicare.
Well, so let's get into that. So right now, Medicare Part B, and by the way, IRMAA, which we often talk about, impacts Medicare Part B. It's also Part D. You just don't know what that exact surcharge is because your Medicare Part D, that you have a choice of different plans. We know what Medicare Part B is. It's $202.90. That's the base rate per person per month. Now, that's about a 10% increase from a year before. And therefore, the IRMAA increases by about 10% as well. So $202.90. Well, who pays that? If you're a joint filer and your adjusted gross income is below $218,000, then that's what you're going to pay. You're going to pay the base rate. If it's above, well, how far above? And that's where we'll get into some of these IRMAA bands. And then thankfully, with this example, it's just half of that if you're a single filer. So married filing separate, or if you're just an individual filer, then $109,000 or less of adjusted gross income. But this is one of the confusing things. Well, adjusted gross income, is that this year? No, it's actually from a couple of years ago. From 2024, that's what's influencing what you're paying for your Medicare in 2026.
Yeah, so if you go back in time to the end of last year, you could know ahead of time what you're going to pay in Medicare Part B premiums just by analyzing your prior tax return, the 2024 tax return. Mm-hmm. But what about this year? We're going through a year of planning right now in 2026, and you're maybe deciding on things like Roth conversions and whether or not to sell some investments at a gain or whatever. This 2026 tax return for you will have an impact on your 2028 Medicare Part B premiums, but we don't know what the bands are out there in the future.
Yeah.
And so you have to make some educated guesses. You need to maybe be conservative. But the point is that this is absolutely a conversation you should be having with your certified financial planner, because it can come back to haunt you if you're not careful here in 2026.
And this is where, when I talk to folks about retirement and how you are going to decide what your income is in retirement, they look at me like there's something wrong with me. I'm like, no. There are levers that you can move to increase or decrease your income. And this is why you want to be working with your certified financial planner.
We're gonna hit some frequently asked questions about IRMAA here in just a moment, and then on the other side of that, get into some of those planning strategies. What can you do to manipulate your income? But just to go a little bit deeper with IRMAA, if you're, sometimes numbers don't play well on the radio, and get that here. You can find all this information at Medicare.gov and then Medicare costs. But if you're over that limit, 200, let's just talk married filing jointly, over 218,000, but you're below 274,000. So this is a fairly small band. I mean, just over 50 grand. Is that 55 grand, 56 grand? Then you're going to pay 284 instead of 202. So what's
$82
that?
difference?
$82 and change different.
Per person.
Per person.
Per month.
Correct. So you might say, well, that's a pretty small window, right? If you're above 274 but below 342, then you're paying double the base rate.
Yeah.
It's 405.80. From 342 to 410, you're paying $527. And Kevin, you mentioned it earlier, I believe. The highest band, if married filing jointly, you're over $750,000 of income. So that'd be selling a business or a big capital gain that you just said, well, I need to sell this asset or whatever, and there's a big embedded capital gain. $750,000 and above, you're paying almost $700,000. Single filers, it's $500,000. You're almost paying $700.
And there's no way you can follow all those numbers listening on the radio or whatever. But again, check out those tables. But here's the moral of the story. Mike said this earlier. If you go $1 into the next band, you pay the higher rate for the entire year. Mm-hmm. And going from first band to the second band, it's about $2,000 per year per couple. It's even worse if you go from the second to the third band. Yep. And so your income control and your planning, those decisions that you were referring to, Kevin, that a lot of people don't even realize that they have so much influence on what their income is in retirement. It matters because it will cost you more each year out there in the future if you jump into a higher band for IRMAA.
So does this mean you've got to be planning for this in retirement? Yeah. But should you be planning throughout your career? Yes. And we're going to show you how. We've got that more coming up here on the Wise Money Show with Korhorn Financial Group. Hello, YouTube. Thanks for being here. This is the Wise Money Show. What you're watching right now is our weekly 1-hour talk show that airs right here on this channel at 10 a.m. Eastern Time every Saturday morning. Also on podcasts at the same time, but also on a couple local radio stations at the same time as well, which is why the content's structured the way that it is and broken up into segments. This is a commercial break for the radio. But if you're looking for something shorter form or more direct content, even, shorts as well, we've got all of that right here on this channel. Over 2,000 videos in the library. So make sure you hit that subscribe button, turn on notifications so you're made aware every time we drop new content. If you like the content, share it, leave questions, comments as well. We appreciate all of that. All right. I mean, do you think you're going to face IRMAA? Are you planning for it right now? Or when you project out, are you expected to pay it? Curious. I do wonder, of those on Medicare right now, what percentage are paying IRMAA?
I wonder, does the government publish that? I bet that'd be knowable, wouldn't it?
Mm-hmm. Kevin's asking perplexity at the moment. What'd you come up with?
Okay. So I think, this is just to have the awareness, because this is the shocker. Currently, 7 to 8% of Medicare beneficiaries are currently paying IRMAA surcharges. About 5.1 million beneficiaries, Part B, of the 70 million. So the issue is these are the folks that we're working with.
Yeah.
And so they are the ones that get the nasty gram that says, oh, hey, by the way, your Social Security is reduced. It was $202 a month, and now it's $300 a month.
This is why it's so frustrating, because you feel like, well, no, I'm doing this financially responsible thing, and then penalized. Yeah.
Well, and just like the government, there are some levers the government can pull on Social Security benefits very quietly without the population knowing it's happening. All they'd have to do is start slowing down the pace that they increase their bands, and all of a sudden it's not 7 to 8% of the population, it's 20 to 30% of the population that are being impacted by this. So you need to be planning. You need to understand how it works, because they might not have their sights on you right now. You're not in the bullseye right now.
Yeah.
But what if you get there?
Could be. All right. Curious. Did you guys take a look at these FAQs? I'd love to hit them like rapid fire.
Yeah.
Not like in a rush, but I think just these are common questions that people have. And
Yes. And let's draw these questions back to financial planning.
yes. All right, here we go. Second segment. One of the frustrating things about IRMAA, income-related monthly adjustment amount, the surcharge you'd pay on Medicare, is it's if you're financially responsible and you're saving up and you're working hard, you've got high income, or maybe you've got a lot of assets and you're drawing them out in retirement, it feels like a penalty. It feels like a penalty for doing what you should be doing anyway for your retirement. We want you to plan ahead and avoid those penalties, to do the right things financially, but not have this penalty. We're talking through that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Stay up to date on all Wise Money content. Find us online, wisemoneyshow.com, and then all over social media, wherever you're at, we are there as well. Search the Wise Money Show. FAQs with IRMAA. That's enough acronyms. Frequently asked questions for income-related monthly adjustment amount. There we go. Why is IRMAA based on your income from the prior year? Why is the prior rule even a thing?
Because we've got lots of rules.
This one's actually logical, even though it's so
preferable.
frustrating.
Yeah.
It is preferable.
Well, consider the alternative. If we have benefits or in this case, payments that you have to make, and it's income adjusted, so it's based on what you're earning in a given year. If it was real time, here what you're earning in 2026 is going to have an impact on what your cost is for Medicare Part B. Nobody knows what you're going to earn for 2026 yet.
Healthcare.gov. Like
Exactly.
we are
Right.
in that mess right now.
That's
That
right.
is the greatest example of that.
So you could be in a situation where all throughout the year you think you should be paying Part B premiums at the lowest tier, and then all of a sudden at the end of the year something changes. And what would have to happen on your 2026 tax return? There'd have to be some sort of true up, and you owe the government a bunch of money that you didn't think you needed to.
So the reason why it's so that's what they're doing with, if you're getting your health insurance through the exchange, healthcare.gov, the marketplace, whatever you want to call it, Obamacare, that's how it works. And it creates this wild confusion and a lot of tax surprise. You need planning in that situation to navigate that. But the prior rule, so at the beginning of 2026, so when this, when you're planning ahead for 2026, probably, November, December of 2025, what's the most recent tax return that you filed? It's 2024.
Mm-hmm.
So 2024 is what influences your 2026. And even though it makes it very difficult to plan, that's why IRMAA is based on your income from 2 years ago. Prior year.
Most similar thing that maybe you've experienced in recent history would be if you've sent kids off to college and you filled out a FAFSA form. And it's income-based financial aid. Well, we need to look back a couple of years because that's the most recent tax return that you have filed, and we're going to base all of our calculations on known numbers instead of forecasted numbers.
Okay, so here's the logical follow-up question to that. Well, then, since I just filed my 2025 return, do I know if I'm going to have to pay IRMAA in 2027? No.
You don't, because they haven't published those yet.
Correct.
Right?
Those numbers will be published in late 2026.
So as you're going throughout 2025 and you're trying to manage IRMAA, you don't know, well, what's the threshold? What's that $1 over that I need to avoid, because those amounts haven't even been published yet. So therefore, how do you plan?
Yeah, I was going to ask you guys, what's your solution to that when you're working with clients? To me, the conservative approach is to work off of the last known bands with IRMAA, which would have been based on the 2024 tax returns. Mm-hmm. If you take your 2026 income up to that level, then you should be safe, right? Yeah. You're leaving at least some amount of cushion there in case something changes and all of a sudden your income comes in just a touch higher. You've got maybe a little bit of grace built in.
Josh, you mentioned earlier that this is one as a financial planner, this one makes you really nervous. So early in my career, I had some individuals that we talked through. They owned a business, and part of selling the business was going to be also working there for a certain period of time. And so there was going to be this chunk right at the beginning of the retirement where there was going to be high income. And we had talked through IRMAA, but I'll just tell you, there's some people that are frustrated with IRMAA, and then there's other people. And they were in that category. It was not enjoyable.
It was as if you'd imagined IRMAA yourself.
Yeah, right. It was my fault. And so anyway, we worked through that. It wasn't great. Well, then we've, fast forward a decade, and we've been doing planning, doing Roth conversions and some cash flow planning. And there was a surprise amount of income that they weren't planning on. It wasn't in our projection, but that landed on their return, and it put them over the current bands by a couple grand. And I was sweating. Yeah. Because we didn't know. And, we talked about it. Hey, this could be a problem for IRMAA, but, that's been increasing. And thankfully, it increased bigger than that. So we were fine. But I do think conservatively, you plan for the most recently published bands. Mm-hmm. And yes, you hope that they increase them because they have. But I think that's how you got to plan ahead.
Yeah. And I would look, really the planning, you're doing kind of blunt instrument planning. So this is not precision planning. So what I would be looking at is, okay, how close am I to the 218 number? If I'm close, there are things that I can do to adjust my income down, possibly, or not take as much income in this year, push it to next year, whatever. But really, you need to look at the bands. Think between 218 and 750. And then if I'm close to the next threshold, is there something that I can do to manipulate my income down in this situation to avoid it?
Here's why, we say this on the show all the time, that tax planning needs to be part of your normal rhythm throughout the year, but especially in the fall. You run a tax projection and you're most likely looking at it from a tax perspective, right? Like you're looking at tax brackets and am I getting close to the next one? Is there any strategy that's happening there? This is why your certified financial planner, your CPA, your insurance experts all need to be collaborating together, because you do a tax projection with just the CPA and they're just looking at this through the angle of what's it going to do to your tax picture. They may completely miss the fact that you just triggered an unnecessary IRMAA, which doesn't show up on the tax projection. It doesn't feel like a tax until you're paying it. And then the fact that you're paying more in Part B premiums than you needed to or you intended to, that feels an awful lot like a tax increase, right? Mm-hmm. And so you may not have taken that action if you were looking at this through multiple lenses.
Mm-hmm.
And if your financial advisor says, "Hey, go consult your tax advisor," and it's hard, you might want to consider, who's my team?
Yeah.
Who is my team?
I would go consult a new financial planner.
Mm-hmm.
Does selling my house trigger IRMAA? We are in housing season. Is there even housing season anymore? I don't think. I think that retired. We'll see. But if I sell my house, does that trigger IRMAA? It could. Depends on is there a taxable gain on your house?
It's unlikely, right?
It's very unlikely.
Most people don't pay. They don't have to include the gain on selling their house on the tax return, because if you're an individual and you sell your house at a $250,000 gain, the first $250,000, as long as you've lived in the house at least 2 out of the past 5 years, you don't have to count it as income. And it's double that for a married couple. Yeah. So you would have needed to hold your house for a long time and have some major appreciation before $500,000 is being exceeded. But as soon as you start having that extra gain above that freebie limit, now it can start having an impact on your tax calculations, which is what IRMAA is based off of.
And that's where you want to be in advance of selling your house, talking to your financial advisor and say, hey, what should we do if you're close to the next year? Do we do it in this year? Do we push it in next year? How do we control that?
Yeah. One of the ways that as you're building your financial house and your financial portfolio, again, this is one of the frustrating things with IRMAA, is it feels like it's a penalty for those who have been financially responsible. And if you say, I know, I'm going to use tax efficient bonds as part of my investment portfolio in my non-IRAs, so municipal bonds, so that the income is tax efficient, certainly that's going to help me with IRMAA. Unfortunately, no. Tax-exempt interest is included in the calculation for IRMAA. We tend to oversimplify when we're just trying to communicate all these complicated concepts, and we say adjusted gross income or AGI. Most of the time, it's modified adjusted gross income, and this is one of the examples. Well, what does modified mean? You add back a couple of things, and one of the add backs is tax-exempt bonds. Now, that's not saying that you shouldn't use muni bonds in your portfolio, but it's not going to help you with IRMAA. What are some of the other frequently asked questions, as well as planning ahead? We've got that and more here on the Wise Money Show with Cohorn Financial Group. All righty, third segment. Get this one a lot, and this could be the entire segment here. These 3 questions, these are good. At first, am I stuck with it? That's probably a quick answer, but definitely a question that comes up a lot. Mm-hmm. I'm pretty certain we'll get the question here in the comments. So hopefully you're sticking with it and you hear us answer it on the show. Here we go. Once I want to hang on. Yeah. If in retirement you find yourself where, you weren't able to manage your income, maybe you sold a business, something occurred, and you had to pay IRMAA, are you stuck with it? Do you have to pay IRMAA then the following year as well, and the next year, are you stuck with it, or is there something you can do, and maybe is it a one time, 1 year at a time sort of thing. We're helping with that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on podcast. Wherever you listen to podcasts, just search the Wise Money Show. Subscribe to it there so you're made aware every time a new episode hits that platform, and rate the program there as well. We appreciate it. We're talking through IRMAA planning, about to get into different scenarios that and strategies that you can implement wherever you're at, whether you're in retirement or still during your working career. How can you plan ahead to avoid IRMAA? But hitting some rapid fire, frequently asked questions. Guys, once you get IRMAA, if you happen to have it 1 year, are you stuck with it?
Thankfully, you're not. It's a 1 year sentence. Once you've calculated your prior year's tax return, so here we are in 2026, and the Medicare Part B premiums that people are paying this year are based on their 2024 tax returns. Well, a year from now, next year, it'll be based on their 2025 tax return. Yep. And so it'll be a whole new calculation, a new determination to say, am I still creeping too high on the income with those IRMAA rates? And am I going to have another surcharge again in 2027? And if for some reason that 2024 return was just a bigger than expected or bigger than normal year, and you are paying for it now in 2026, if 2025's tax return was better or lower for you, then it's possible that you drop back down into a lower band and the surcharge is gone for that year.
And that leads to the next question. And we get this one a lot. I've already filled one of these out with a client this year. It was unsuccessful as I expected, but still worth trying. Is there a way that I can appeal IRMAA? Is there, if I get slapped with that, is there a way that I can say, no, this isn't sustainable. This isn't normal. It's just a one-time thing. Yes, there is, but it's not what you think. This is, and I believe it's an SSA-44 or SS-44, a life-changing event form. It doesn't work the way you want it to, because here's how you want it to work. Oh, my normal income's low, and I just had this weird spike in income. Please don't make me pay IRMAA for this 1 year. I sold this business. I sold this property. I took too much out of my IRA to cover the house that we were buying, or the house renovation, or the car we were buying. My normal income's low. It spiked. Please forgive me. And sadly, guys, that's not how it works. It's the opposite. It's my normal income's high, and a change just happened where it's going to be low moving forward. Please forgive me now. That's how it's designed to work. And now it's very, very frustrating. And so if you're on the other side of that, so just had an individual who sold a property a couple of years ago. It was a vacation home. It was not their primary residence, so the gain was taxable, and it wasn't a ton of income or taxable gain, but it was about 70 grand or so. That's meaningful. Push them into IRMAA. Hey, normally I'm not going to pay IRMAA. Now I have to. Will you forgive me? And you go and you fill out the form, and it asks you, well, what are the life-changing events? A loss of income, a loss of your job. You change, you had a marital status change. None of it aligned with, oh yeah, I sold a property, right? And so I still feel free to fill out the appeal, but it was rejected, and they got to pay IRMAA for a year.
Yeah, so basically this form is to provide some relief for those people who that tax return that IRMAA is calculated off of was a high income in the past, and now your circumstances have changed, and it would be tight to be able to afford the surcharges that you're being penalized on. And so can I appeal and say, hey, listen, ignore that high income. I'm in a much lower situation now. Give me some relief.
Yeah,
essentially.
I mean, basically, it's for this scenario. Think about it. And there's many different ones, but this is maybe the most clear. You work all the way up until age 65, and your earnings through your job, you make $300,000 a year. And therefore, when you stop working at 65 and you turn on Medicare, they're looking at your income, your tax return when you were 63. That's when you were working and you were earning $300,000. So they're going to slap you with IRMAA, and you can fill out this form to say, no, I'm retired now. I lost that income. My income's not going to be at that level. I'm going to be below these levels moving forward. Therefore, don't make me pay IRMAA. And I think that's a legitimate reason. I just wish there was also the, hey, I just had a strange spike in my income. Please appeal me, and or let me appeal, and they don't let you.
Yep. So annually, your IRMAA is going to stay the same. It's going to go up or go down or go away. So you need to appeal within 60 days of getting your IRMAA notice.
Yep.
And we've seen successful appeals and unsuccessful appeals.
That's right. All right, last question here in frequently asked questions, and this one we could spend a little bit more time on. Should I avoid doing a Roth conversion if it causes IRMAA? Is that like, hey, I'm going to have to pay IRMAA, and therefore it's a bad idea to do a Roth conversion? I would go on record to say no. You don't want it to be a surprise, but it's not a reason to
don't immediately rule it out, you're saying?
Correct.
To me, it just has to be part of your calculation,
Yes.
right? Because when you do your tax planning in the fall, you're running a tax projection, here's the process you go through. You want to start with a baseline expectation of what you think your tax picture is going to look like if you do nothing. Then you run a second scenario that says, well, what if I do this Roth conversion? And what you're trying to calculate is, well, what is the tax impact of me moving money from a traditional IRA over to a Roth? That's the cost of doing the maneuver, right? Well, what people lose sight of is if there is it's going to cost me $15,000 to do this Roth conversion in tax increase. If you also throw another couple grand on top because of IRMAA increases, the real cost to you is $17,000. Does that math make sense? That combined true cost?
Yeah.
And the answer is it might still make sense.
Yep.
Right? So don't just rule it out just because it's an extra cost. Rule it in or rule it out based on the right calculation with your plan in mind, with your certified financial planner.
Yeah, I was just working on one of these, and it made sense to go up through the first IRMAA bracket, because when you look at the several $1 million in retirement plan money, that's the RMD is spread over 2 lives. Well, when you are down to 1 life, you're getting close to the top of IRMAA between Social Security and RMDs. Mm-hmm. So all of a sudden you say, okay, right now you were just below, but it definitely made sense, because then the beneficiary of if you think about it, the $4 million IRA, the final beneficiary is going to need to take $400,000 a year out of it, even if there's no earning, just to get the thing depleted in 10 years.
Right.
And so the tax planning, man, it's so important that we do it now and with an eye towards the future.
I would completely agree. This is not a lot of financial professionals say it's going to trigger IRMAA. You shouldn't do it. So therefore, don't do the Roth conversion. And there's not a one size fits all. You just need to bake it into the calculation. This is a long time ago, but we have the benefit 2020 vision hindsight here. I think it was 2016, so 10 years ago. The market was facing some turbulence, and was working with an individual who was just recently retired, had about $600,000 in pre-tax and another $300,000 or so in Roth. And we started, hey, I think you should do a Roth conversion. We sort of walked through that strategy, and we looked at what the math was going to be. And he came back and said, yeah, I think we should, but let's do more. And so we did a little bit more, did a little bit more, did a little bit more. And he decided he wanted to max out IRMAA for 1 year so that he could convert the maximum amount so that he would never have to pay IRMAA again. It was basically, I'll pay a ton of tax in 1 year and IRMAA to stay in the 12% tax bracket for the foreseeable future. And it was like, yeah, but you don't know if this account is going to grow the way that you think, but all that sort of stuff. Well, the last 10 years in the stock market has been incredible. This has been an unbelievable plan and strategy for him. So you just need to factor it in. If it's a surprise, that's when it feels painful. But yeah, it can certainly, don't rule out Roth conversions early in retirement before RMDs, even if it means, or just because it means you might pay some IRMAA. Right now, you also need to navigate around losing the senior deduction or some decline in the senior deduction. So there's a lot of things, a lot of potential landmines, but that's where the planning is so important. Proactively planning ahead to see what adjustments to make. All right, we got more coming up here on the Wise Money Show with Korhorn Financial Group. Okay,
fourth segment?
Fourth segment. So all the strategizing will hit in this segment. So
putting the kickstand down.
Yep. Here we go. Thanks for being here. This is the Wise Money Show with Korhorn Financial Group. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show, if you've missed any of this episode or want to catch more of it, it's all on the Wise Money YouTube channel. Go to YouTube, search the Wise Money Show, subscribe to it there, and then turn on notifications so you're made aware every time we drop new content, because it's not just this talk show that is there. The full library is over 2,000 videos now. We've got Next Wise Step videos that air all throughout the work week, 10 minutes long. We've got shorts as well, all designed to take financial concepts or financial challenges or opportunities and apply it to your financial life through a comprehensive financial planning approach, looking at all 6 areas of your financial life. So go to YouTube, search the Wise Money Show, subscribe to it there. We appreciate it. All right, guys, IRMAA. We've been talking through it. It's time to plan through it. If you are, we're going to do it in 2 different categories. If you're not yet retired and you've hung with the show so far, kudos to you, by the way. But if you're not yet retired, this means you've got a lot of opportunities to plan ahead for IRMAA.
Mm-hmm.
How? What should you be doing? What are some of the strategies you could be doing right now during your career to help minimize the risk of needing to pay the IRMAA surcharge in retirement?
Well, the earlier you start, the more options you have, and the closer you get to it, the fewer options you have. So if I'm in my 40s, I'm looking at what should I do as it relates to the mix in my retirement plan contributions. Should I be doing pre-tax or should I be doing Roth? Because that growth on those dollars are going to have the longest amount of time to grow. So if I'm doing pre-tax and those dollars grow a long time and get to be really big, they become almost cantankerous. And you say, how in the world do we deal with this? And if you've not sat down and done planning for folks that have a $5 million IRA, and if you're listening to this, you might be thinking, well, I'd like to have that problem. Yeah, a lot of people like to have that problem, but I can tell you this, it's not a very manageable problem when you look at a $5 million IRA kicking off a required minimum distribution of a couple $100,000. Because now if I'm a married couple, boom, I'm already in IRMAA land. And if I'm a single person because my spouse has died, now I'm well into the higher side of IRMAA.
Yeah. You're describing a situation where someone has had some financial success. They've clearly made some great decisions along the way, or they've been the beneficiary of, some great inheritance or something. Like there's good stuff happening, but you're also describing inflexibility in their situation because it's all taxable when you start drawing off of it in retirement. And then the only thing that you can do to control your income in retirement is just reduce the amount you pull out, which may be reducing your lifestyle more than you intend, that sort of thing. It's part of the reason why I think, Kevin, what you were alluding to is being more tax diversified in the way that you're building for retirement. Not having all of your dollars be in a traditional 401k, for example. Should some of them be Roth? Should there even be some investments that are building outside of those tax shelters, just to give you flexibility in how you draw or create income in retirement? That will give you a lot of power in deciding what we were saying earlier in the show. You get to decide what your income is going to be in retirement if you put yourself in a position where you have that kind of flexibility and choice.
Determining pre-tax or Roth. And if you're looking at saying, well, I'm in the 12% tax bracket, it's clearly advantage Roth. I'm in the 22%, so shouldn't that mean I should get I should get the deduction today? Based on current tax rates, the current tax tables, now this is taxable income, not modified adjusted gross income, but the IRMAA band stands like right in the 24% tax bracket. So think about it. If you're in the 22% tax bracket right now and you think, I kind of want the deduction, well, but out there in the future, paying IRMAA would be, well, I'm in the 24% tax bracket. Now the 22% tax bracket feels like a good deal. Pay that now and have Roth dollars. Second, HSA.
Yep.
and shoeboxing your HSA. And then third, if you're not maxing out all of your tax shelters and you're saving some dollars on the side, maybe investing it in a play account or just some fun money, or you're just not so sure you want to put everything in your 401k, and so you're building up some dollars somewhere else, those dollars are going to create capital gains, are going to create interest, dividends that will land on your tax return out there in the future, and that could cause you to pay IRMAA. Consider getting some of those dollars, fill up your tax shelters first throughout your career, I think is how I would phrase that simply.
Well, and that's especially important a couple years before retirement as well, because again, we look back 2 years to decide whether or not you're going to pay extra on your Medicare Part B premiums in the current year. So first year of retirement, we're looking at a couple years prior when you may have been in your peak earning years. You may have been up creeping into IRMAA rates, and maybe for whatever reason you were emphasizing Roth contributions during that stage, and maybe mathematically traditional contributions would have been better for you. So don't lock yourself into just one strategy or just assume that every year is the same. You really do want to be thinking out into the future when you're making decisions right now in this current year.
Taking advantage of Roth conversions, timely Roth conversions during, if you look and you say, yeah, we're in the 22% tax bracket. And you know what? We've got a lot of room here in the 22% tax bracket during our career. Doing some Roth conversion, you'll need to figure out how to cover the taxes. If you withhold taxes on the Roth conversion, then that withholding is penalized. And it also means there's less money landing in your Roth IRA. So I'd love for you to find a way to cover the taxes a different way. But Roth conversion's one. Now, guys, if we expand it to say, well, what are some of the IRMAA planning strategies if you're already retired? I mean, I'd put Roth conversion at the top of the list as well.
Yeah. To me, the most important thing to remember when you're retired is just the discipline and the habit of consulting with your certified financial planner to test anything you're imagining doing, like any strategies that you're contemplating or any actions you're thinking about taking in your financial life. There could be tax ramifications, and if there's tax ramifications, there could also be IRMAA implications. And so your tax projection work to test out whether or not that Roth conversion is a good idea still in retirement. Should you be pulling a big chunk of money out of an IRA for a big purchase or a big project or something? Or should you use debt instead to spread out that income into multiple tax years instead of getting hit with IRMAA in this one? So anything that you do in retirement may have tax implications, and you need to test it first.
Right. And when I think of tax planning for IRMAA, I think of painting myself into a corner, because if $218,000 is the number, and I say, all right, based on all my sources of income, I'm going to convert and create even more income to get me right up to the $218,000, and I have not made a provision to pay my taxes, I just put myself in a difficult spot.
Yeah.
And I don't want to have underpayment penalties. I don't want to that might make decisions for what my income is going to have to look like next year so that I've got money to pay my tax bill. So there is some fancy footwork related to this. I would say it's simple in concept, but it's complex in the execution of that concept.
It's stuff like this, though. How often do you get the question from someone who is marching into retirement? Maybe they still owe some money on their house. Maybe they owe $100,000, and so many people are like, "Should we just pull $100,000 out of our IRA and just wipe that thing out? That would give us so much peace of mind and everything." And we're always quick to point out, well, you don't have to pull $100,000 out of your IRA in order to pay that off. It is something significantly more. And what are the unintended consequences? IRMAA is often what we point to, and it's what rules it out as just a lump sum debt reduction strategy on the eve of retirement or even in retirement.
Well, that's where I go back to, actually, Josh, it wasn't top of mind, and I don't know how it wasn't, but you said if you're in retirement, your most important act to manage IRMAA is to scenario your tax planning. Like scenario your before you make a big financial decision, lay it out in a tax projection. What, not just back of a napkin. How's this going to impact my tax return? You're likely to forget something. You're likely to just assume. and instead actually build out that projection. That's one. The other thing I'll just slip in here, qualified charitable distributions, you got to wait until 70 and a half to do those. So that doesn't apply to everyone in retirement. But after that time, looking at qualified charitable distributions if you are charitable. The point is, I go back to what Kevin said. The earlier you start planning for IRMAA, the more choice and flexibility and options you have. The longer you wait to plan ahead, fewer your choices are. Start that planning process today. Work with your CFP. That's all the time we have for today. On behalf of Josh Gregory, Kevin Korhorn, all of us at KFG, have a great weekend. We'll see you next Saturday for the Wise Money Show with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.